In this video, you will learn that even as a complete beginner getting started in the stock market, you can take less risk and in doing so avoid the hit and miss of investing in the stock market by being more active. You will also learn what to invest in and why you're investing in it so you make better decisions. Here are the 5 steps I'll take you through. Step 1, you got to understand what you're really investing in. Step 2, set clear goals and stop guessing. Step 3, how to get started investing in the stock market with as little as $500. Step 4, breaking the stock market myths that are holding you back. Step 5, thinking beyond set and forget. How being more active gets better results. I'm Gillham, the Chief Analyst from Wealth Within. I have over 30 years experience in trading and investing. I'm the author of 2 best-selling investment books, a keynote speaker across Australasia, and wrote Australia's only government-accredited stock market education course. So let's get into how you can get into investing in the stock market with as little as $500. Stocks or shares. You may have heard one or both of these terms. You may have also heard the terms stock market or share market. In the USA, they talk more about stocks and don't really use the word shares. Whereas here in Australia, given that we tend to look at or follow the US market, we use both terms to describe the same thing. Right now, you may not really understand what a stock is or how the share market works, so let me explain. The stock market is a centralized place where buyers and sellers trade shares of publicly listed companies. At the heart of a stock market is an exchange, such as the Australian Securities Exchange, or ASX as it's known, or you may be familiar with the Dow Jones and S&P 500 in the USA. A stock exchange provides a centralized digital mechanism for the trading of shares. Think of it as an online auction for the buying and selling of stocks. The buyers place bids to purchase shares at a price, and the sellers place offers as to the price they will accept for their shares. All stock market exchanges do more than just facilitating the buying and selling of shares. They also provide companies with the ability to undertake corporate actions such as listing or what is known as floating on the exchange, which is also referred to as an initial public offering or IPO. So why does a company float? Generally, it is so it can raise capital for growth. Once a company has listed on an exchange, its shares can be freely bought and sold through an exchange. The company goes from being privately held to being a public company. A stock exchange also provides investors with a regulated and safe environment to profit through stock price increases and income generation through dividends. When you buy a share, you're not buying a lottery ticket, you're buying a piece or share of a business. Let's say you and your 5 friends put $5,000 each into setting up a company for the purpose of buying a struggling cafe for $25,000 because you believe in its potential. Now the company issues 25,000 shares, and so each of you get 5,000 shares for your investment, with each share worth $1. Now through your share ownership, each of you owns 20% of the company that runs the cafe. Now you all work hard in the cafe and it starts making good profits. Given that each of you owns 20% of the cafe, you all share 20% of the profits it now makes, and you also enjoy 20% of any growth in the value of that cafe. Let me explain. After a year, the cafe makes $10,000 in profit. You and the other shareholders decide to pay 50% of the profit as a dividend, which is $5,000 or 20 cents for every share. Given that each shareholder owns 5,000 shares in the company, each shareholder will receive $1,000 as a dividend. Sometime later, someone has seen what you've done with the cafe and offers you and your friends $100,000 for your cafe, which represents $4 for every share. You are all still holding 5,000 shares in the company running the cafe, and so your initial $5,000 investment is now worth $20,000, which is calculated using the number of shares you own, being 5,000, multiplied by the offer of $4 per share. Your investment in a stock listed on the stock exchange represents ownership in the company in the same way. So this brings us to the first important point. Stocks make you money in two ways. Capital growth, this is when the price of the share rises, and in the example, the share price rose from $1 to $4. You also make money through getting dividends, which is when a company shares its profits with shareholders. In the example, the shareholders got $1,000. Now to the elephant in the room. Contrary to what many have been led to believe, the stock market is not a casino and it's not gambling if you have some basic knowledge. The stock market is a place of opportunity if you understand the rules of the game. Let's now get into step 2, and that is to set clear goals and stop guessing. You need to know where you're going, so you know how to get there. So first up, you need to ask yourself a very important question. That is, why am I investing? Is it for long-term growth, financial freedom, an extra income stream, or something else? This is an important step as it shapes the next steps you take. In my 30-odd years of trading, teaching and mentoring about the stock market, I've found the vast majority skip this step and, in doing so, end up going down the wrong paths, wasting time, making mistakes and generally not being that successful in the stock market. You see, your why determines your what and how. For this step in getting started with investing in the stock market is to write down your why and to do so in as much detail as you can. Then I want you to take an extra step that in my experience most never consider. That is, you need to answer this question. How will achieving this change your life? This is a critical key point, as this is the real reason why you're watching this video and wanting to get started with investing. You see, investing success is 80% mindset, or how we think about investing, and 20% is how you invest. Once we understand why, then the rest falls into place. Now to step 3, which is how you can start to invest in the stock market with a small amount of money. Here I will share how you can get started with as little as $500. In fact, it does not matter how much you have now. It is far better to start investing in the stock market with small amounts whilst you build your knowledge and gain confidence. Think about it like going to the beach and dipping your toe into the water to feel the temperature. So let's now get into the exact steps to get you started. First, I will say that in following these steps, you will be better and more profitable than most at the share market. You see, at least 90% of people who invest don't have a process. Given that, they tend to invest more emotionally, follow trends, struggle to sell, and often panic when the market is more volatile. I am sure you wish to avoid all of that. Here's how to take the first step so you start the right way. Think of a broker as the middleman. You can't walk into the stock exchange and shout, "I want to buy BHP." You need a licensed stockbroker to do it for you. Your broker can be a person you call on the phone who will give you advice and help you, or you can deal with a stockbroker via a website. In Australia, these are companies such as CommSec, Bell Direct, and others. In the USA, there is Charles Schwab, Fidelity, JP Morgan, and many others. To help you understand more, there is a link in the description to an article I wrote on brokers. Now in Australia, we have a unique system that really helps investors, and this is called CHESS. This stands for Clearinghouse Electronic Sub-Register System. Boring name, but critical feature. It means the ASX has a record that you own the shares, not the broker. If the broker goes bankrupt, you still own the shares. And all you have to do is give a new broker your CHESS number and you can buy and sell as normal. This is very different to using some of those apps such as Raise, Robinhood and the like, as they use custodial services. Think of custodial services like a big bucket where everyone's shares and cash are held by the custodian on your behalf. If you use a custodial app that isn't CHESS sponsored, and if it goes bust, you might be in trouble. Another important point when looking for a stockbroker to buy and sell for you is funding your account. Here, some brokers will use custodial services, whilst others will let you use your own bank account. If they use custodial services, when you open a broker account, they will give you a unique BSB and account number linked to your trading account. I prefer to use brokers that will allow me to use my own personal bank account to transfer money to and from. This way my money is always in my own name, and this means I have greater control and security over it. When you buy, the broker will send a notice to your bank to transfer money to them, and when you sell, they will send the money to your bank. Here there are three parties involved in the transaction, which are you, your bank, and the broker. The communication is electronic via what are known as contract notes. A contract note is a record of the transaction and the costs of that transaction. When you buy or sell, a contract note is issued by your broker. You should check it to ensure they have done what you've asked. If there's an issue, you'll need to contact them as soon as possible. You have a little time, as when you buy and sell, all parties have 2 days to settle the monies. Basically, the money will not leave your account for 2 days if you buy, and you'll not get the money from selling for 2 days. Now shortly, I will share with you how to buy and sell with your broker. But first, let's get into how to find the right share for you. Start with quality companies and not the latest fad or hype stocks. Here I suggest one of the top 20 companies in the Australian stock market. Stocks are ranked by market capitalisation, or in other words, how large they are. This is calculated by multiplying the current share price by how many shares a company has issued. So a company that has 1 million shares issued would be worth $1 million if the share price was $1, or $10 million if the share price were $10. What may surprise you is that I would generally advise staying away from ETFs. Often I see videos with perceived experts telling new investors to just use index tracking ETFs. And I must say that I cringe when they say it. Those doing the video say it's simple and it gives you more diversification. Simple, yes. The rest they promote is just wrong or misleading. Investing in index tracking ETFs is not only poor investing, but it is also dangerous if the stock market crashes. Here's a fact. If you have a selection of the top 20 companies, you will outperform index tracking ETFs and do so with lower risk. It's also easy to achieve and does not take much time. But let's get back to selecting the companies to invest in. Your broker website will have information on all companies, as will the stock exchange. Many good websites provide services that will give you data on your favourite companies, such as Yahoo Finance, Morningstar and many others. The trick here is that less is better. Picking one good site is far better than searching all over the place, as I see many investors suffer from information overload, and this leads to confusion. What do you look for when wanting to invest? I like to tell people to look for companies that have a history of double-digit earnings per share, or EPS growth. This means they are projecting that they will make more money in the coming years. If that happens, the share price will rise, and you may even get bigger dividends. You should also look for companies that have a market average dividend yield. In Australia, this is around 3 to 4%. But in saying that, I would not avoid companies that pay a lower dividend. Whilst enticing, I would also not chase companies that pay larger dividends, as there can be issues with that. Now let's buy your first share. All brokers' order forms are pretty much the same. So here's what you need to do to place your order to buy your first share. Once you log in, you will see a menu item called Orders, or you may see a field titled Quote. Regardless, you type in the stock code of the stock you wish to buy. Once that comes up, you'll see a Buy and Sell button. Click on the Buy button to bring up the order pad. You can relax as you've not bought anything yet, just brought up the order form. In the order form, type in the stock code of the stock you wish to buy in the space provided if it's not already been pre-filled. You must take your time here and make sure the right stock name comes up. Double and triple check it, as you don't want to buy the wrong stock. On the order form, you will see the current price of the stock. You then divide $500 by the current share price to work out how many shares you're buying. You place that number into the space on the order form, and the order form will tell you the total amount in dollars that you're buying of that share. It will also have a brokerage fee, Once you've checked everything again and you're happy, then click the buy button, which is generally green. At this time, your order will go into the market and you've bought your first share. Remember, initially the goal isn't to make a fortune on this first trade. The goal is for you to follow a process, build confidence and understanding. So, congratulate yourself. That's it for buying your first stock. The good news is that selling a stock is just as easy. That said, in my experience, most investors struggle with the emotion of selling stocks, whether in profit or loss. But here lies the key to making money in the stock market. If you get good at selling, you will make more money and have less risk. This brings us to tax. Yes, that old saying goes, we can't avoid death and taxes. In Australia, when it comes to the stock market, you can be taxed as a trader or an investor. Given that this video is about getting started at investing in the stock market, I will stick to investors. Outside of GST that you pay through your broker when you buy and sell, investors in stocks have two taxes they need to be aware of. The first is capital gains. If you make a profit, then this needs to be declared in your tax return for that financial year. In short, some of your profit is taxed by the government. If you make a loss when you sell, then the loss is also recorded in your tax return for the year and it will offset against any capital gain you have during that tax year. How much the gain or loss will affect the tax you pay will depend on many factors that your accountant will figure out. One of the biggest mistakes I see investors make is not selling so that they don't have to pay tax. I won't explain why in this video. I will only say that often it's far better paying the tax so you can compound your return than to hold only to see the value of your share fall. Now to dividends, which are treated as income. As with all income, you must declare it to the government on your tax return. It goes on there just like income from a job or from other investments, like an investment property. In Australia, we're lucky that our government allows us to get franked dividends. This is when the company whose shares you own pay the dividend after they've already paid company tax. They will pass on a franking credit to you for tax already paid on that income, and this can effectively reduce your tax. In a minute, I will show you an example of how you can start with $500 and compound your money into generating thousands of dollars over time, so you make excellent returns. Now that we've taken you through how to find your first share to buy and how to buy it, we need to talk about some very important things that have a negative influence on new investors every day. There are some myths that many investors fall for that cost them time, money, and generally make their investing life harder than it need be. So we're now at step 4, and step 4 is about breaking the myths. There's a lot of noise out there, and dare I say, a lot of what I've seen on social platforms is often wrong, misleading, and more often than not delivered by those with little experience or knowledge. So let's bust these myths right here and now. The myth I've seen perpetuated over decades is the myth that you should buy and hold forever. This one myth at worst will lose your money and at best may get you average returns. Buy and hold forever is like buying a car and never servicing it. No stock or market goes up forever, nor do they go down forever. One absolute thing about having a buy and hold mentality is that it will subject your portfolio to a roller coaster ride of wild swings in returns. This is the opposite of what all investors want. So why do it? When I talk to investors, they tell me they want stable growth over time, and this is impossible with a buy and hold mentality. Most of the push for the buy and hold thinking is for investors to buy passive, index tracking investments such as index funds or ETFs, and is driven by the big financial institutions so they make more money, and this, as mentioned, leads to average returns for investors at best. The thing is that when I ask investors if they want to beat the market average, they all say yes. Yet you can't beat the market average if you're buying passive index investments and holding forever. You can if you're more active, and we will talk about that shortly. The next myth perpetuated by the financial services sector is that you can't time the stock market. Whilst I will agree that you can't predict it perfectly down to the day or second, you can, with some simple education and strategies, learn to read the stock market or stock so you are invested at the right time, and just as important, not invested in the stock market at the wrong time. Meaning you can be enjoying the benefits of being in the stock market whilst it rises and out of it when the risk becomes too great. On to the next myth. And again, I see this one so often. This one literally stops people from really profiting from the stock market. What is even worse is that it subjects investors to high risk, and that is dollar cost averaging. We hear from finfluencers and others that dollar cost averaging, or DCA, is the only safe way to invest. When they say this, it means to me that they don't really understand the stock market. Sure, on the surface, dollar cost averaging seems to make sense, but it can and often does lead to poor results. This myth came out of the old insurance days of the 70s and into the 80s, when you got door-to-door insurance guys coming to your house to sell you insurance with an investment component. The idea was that you paid a monthly amount into your insurance and invested at the same time. And over a long period, your investment would grow. Whilst completely different now, the financial planning industry essentially grew out of the old insurance industry of the 80s. So this myth is very old thinking. What I don't like most about dollar cost averaging, it is that it increases your risk. I'll be blunt in saying that anyone telling you to DCA on a video or a blog does not truly understand investing in the stock market, and they definitely do not understand risk. There are many other myths I could talk about here, but that is not the point of this video. You can learn about these myths and others in my book, How to Beat the Managed Funds by 20%. I now want to tell you a truth that I share with many who come to us for education, and that is, knowledge is the enemy of fear. They fear losing, fear of being wrong, and fear of making a mistake. The reality is that by listening to those myths I mentioned before, these investors will get what they fear. This is what many liken the stock market to gambling or to being high risk. The reality is that being armed with a little bit of knowledge and a strategy, you can make informed, confident decisions. Now we're up to step 5, and that is that you need to think beyond the set and forget mindset. Here is where I share with you my example of how to start with $500 and get better returns by being active. Set and forget is also called passive investing. Sounds easy, I get it. Buy and then forget. Sounds all too easy. But the problem is, it's lazy, and worse, does not give you the results you desire and puts your money at higher risk. I've seen so many follow this path of set and forget, only to lose. Let's get one thing straight. When I say you need to be more active in your investing, I don't mean that you need to day trade. In fact, I strongly recommend avoiding day trading. I don't even mean you need to look at your shares every day or even every week. Active investing means staying engaged with your portfolio and learning how stocks and markets move. So let's get into my example. In this example, I've used the ASIC Money Smart Compound Interest Calculator. You can visit the website yourself and play with the figures to tailor them to your requirements. Here we started with $500 and added $500 each month for 20 years. We also assumed an average rate of return on your investment of 10%, which is very achievable with a capital gain of roughly 7% on your shares and dividends of 3 to 4%. Your input is $120,000. You gained $262,848 in interest to have a total over 20 years of $383,348. If you got a 15% return, and assuming everything else is equal, your total would be over $750,000. Whilst these sound like big numbers, they are both achievable if you are an active investor. Whilst the example I've just shared is really about how your money can compound over time, and it required you to be active in continually adding $500 to your investments, it was not really about active investing. Being an active investor means being prepared to sell a stock you own that's in profit. It also means selling if it's in a loss. Selling a stock you are losing money on is the hardest thing you will do. But I know that the more you do it, the more money you will make. As investors, we need to protect both our capital and our profit. And to do that, we need to use a process. You see, if you don't make $10, you just don't make $10. But if you lose $10, then your capital needs to make $11 to break even again. There's a little bit more to it than that, which I outline in my books. More importantly, it is simple. In fact, so simple, literally anyone can do it. Now I'm going to show you the difference between being passive and being active on a stock. This example is on a healthcare stock, and on the 1st of January each year, between 2019 and 2026, we purchased $500 worth of shares using dollar cost averaging. As you can see, during that time, the purchase price of the shares fluctuated up and down. You can see that we bought shares 8 times over 88 months, or just over 7 years, and achieved growth, excluding fees, of 24.53%, or an average annual return of around 3.36%, not including dividends, as of the 1st of May 2026. Now, let's assume we purchased the same healthcare stock on the same date and added $500 to our bank account on the 1st of January each year we held the stock, instead of applying dollar cost averaging to invest. Notice that we are trading on a monthly chart using a simple trend line, which I outline in my book. As you can see, the stock triggered a sell signal on the 1st of January 2021, and we exited at $30.32. So while the stock continued to trend down, we minimized our risk as the money was safely secured in a bank account. Now let's assume we continued saving $500 a year while we waited to re-enter the stock. The stock triggered another entry on the 1st of April 2024 at $23.09, and we purchased 162 shares with the money in the bank. We continued to invest $500 on the 1st of January each year into the bank account while holding the stock. The stock then triggered a sell on the 1st of October 2025 at $32.47, and we exited the stock. So once again, we exited prior to the stock trending down. The cash proceeds in the bank following the last trade equated to $5,764.53. We also invested another $500 in the bank account while we were waiting for another trade. As you can see, we still only invested capital of $4,000, and we currently have $6,264.53 in the bank. If we value the performance at the same time as the previous example, on the 1st of May 2026, then we achieved an overall gain of 56.61%. As you can see, we have more than doubled the return we achieved when applying dollar cost averaging, which is why I do not believe this strategy is in the best interest of traders or investors. So while we were more active with our investing, we were only invested in the stock 49% of the time, yet we compounded our returns. Remember, the returns in either strategy doesn't include dividends or the interest you would have received from holding the assets or the cash in the bank account. They also don't include the brokerage you would have paid to purchase the stocks. But what it does show is that by being a little more active in the stock market, you will get better returns at lower risk. The other advantage with being active is that we could have been investing in other stocks that are rising in value while we were waiting for another opportunity in the healthcare stock. I hope by now you understand that anyone can start investing in the stock market, and that you don't need to be wealthy or a rocket scientist or even take big risks to succeed. Investing $500 in your first stock is just the beginning of an exciting and rewarding journey. Remember, getting started with investing in the stock market is not about making money straight away. It's about building knowledge, confidence, and control over your financial future. If you want more information and education on this subject and more, visit wealthwithin.com.au. Explore our free resources, as we have lots of blog posts, videos, and podcasts to explore. And remember, there are links in the description below.